This is a European factory floor. The lights are on, the machines run, the orders still come in. Nothing here is broken. The question is not whether Europe still works. It does. It is why the rest of the world keeps pulling away from it. One answer starts here. No European company founded from scratch in 50 years is worth 100 billion euros. In America, all 6 companies worth more than €1 trillion were built in that same window. Europe is not small. 440 million consumers and 17% of world output in 2023. Still, the gap grows. Since 2002, Europe's output gap with America widened from about 15% to 30%. Households feel it as pay. Since 2000, real income per person has grown almost twice as much in America. Europe was not always the one falling behind. On the 25th of March, 1957, 6 countries signed the Treaty of Rome. West Germany was the engine. Through the 1950s, it grew almost 8% a year, doubling living standards. In 1945, a European worker produced 22% of what an American worker produced in an hour. By 1995, Europe had almost closed it. 95% of American productivity. 50 years of catching up, nearly finished. And integration paid for itself. Regions that joined the Union closed the gap on the ones that stayed outside. Then the internet arrived. Europe, the Draghi report says, failed to capitalize on the first digital revolution. This is where the line bends. Strip out the tech sector, though, and 20 years of European productivity growth was broadly at par with America. So this is not about holidays. About 70% of the income gap is productivity. The rest is hours and participation. Europe did not fall off a cliff. It stopped closing the distance, one ordinary year at a time. 4 things pulled it apart. The first one is arithmetic. Europe's population is still growing. Eurostat projects a peak in 2029, then a 12% fall by 2100. The arithmetic underneath is blunt. Deaths outrun births by about 157 million. Migration adds 104. The Draghi report puts it flatly. Net migration does not compensate for the decline. The number that matters is the working-age population. 263 million today, under 200 million by 2100. And the ratio turns. By 2040, the workforce is projected to shrink by close to 2 million people a year. Behind every one of those lines is the same shift. Fewer people at work, more people depending on the work they do. The squeeze fits in one ratio. Eurostat's newest projection has old age dependency rising from 34% today to around 62% by 2100. Aging is not one country's problem, but it does not arrive everywhere at the same speed. 22 of the 27 are projected to lose working-age people by 2050. Growth then has to come from doing more with fewer. The second thing arrived all at once. In August 2022, European wholesale gas traded above €300 a megawatt hour. A year later, about 35. The spike passed, the gap did not. European companies still pay 4 to 5 times more for gas than American ones. For electricity, it is 2 to 3 times. A gap that wide stops being a bill. It becomes a decision, taken in rooms like this one, about where to build the next plant. You can measure what they decided. Since 2021, output from Europe's energy-intensive industries has fallen 10 to 15%. Aluminum went first. Electricity is up to 40% of what it costs to make. By 2022, half of Europe's smelters had cut back or shut down. Chemicals followed. The industry body Cefic counts 37 million tons of announced closures across Europe since 2022. 20,000 direct jobs went with them. Almost nothing has been announced to take their place. And Europe is not losing the energy transition. On renewables, it is ahead of both China and America. But clean power has to arrive faster than demand. Data centers already take 2.7% of Europe's electricity, and that is projected to rise. The third reason is the one everybody names. 3 American companies run more than 65% of Europe's cloud. The largest European operator has 2%. It is not for want of engineers. The IMF found American-listed tech firms lifted productivity 40% in 2 decades. Europe's did not move. Look at who spends the research money. Europe's top 3 corporate investors have been carmakers for 20 years. America's are all tech. In 2021, European companies spent about half what American companies spent on research, a gap of 270 billion euros. The research base is thin at the top 2. 3 European institutions sit in the global top 50 for publishing in leading journals. None of this is a shortage of ideas. Europe's laboratories are not empty. What fails comes after the idea works. Europe files 17% of the world's patent applications. The European Patent Office finds only about 1 in 3 university inventions is ever used. Then the money decides. 61% of global funding for AI startups goes to American companies, 6% to European ones. The ones that grow do not always stay. Of 147 European unicorns, 40 moved their headquarters abroad. Most went to America. Others never leave and still look west. Spotify was founded in Stockholm. When it went public in 2018, it sold its shares in New York. Europe still builds the ideas. It does not build the companies that end up owning them. The fourth reason is the hardest to see. On paper, Europe is one market. In practice, a company crossing it meets 27 company laws, 27 insolvency codes, 27 tax systems. Every one of those rulebooks made sense to the country that wrote it. Together, they are a border nobody meant to build. The IMF estimates that trading inside Europe costs as much as a 44% tariff on manufacturing. Other economists dispute the figure. And rules arrive slowly. The average European law takes 19 months to agree. Then follow the money. The Letta report counts 33 trillion euros of private savings inside Europe. And a great deal of it does not stay. Europe's households end up lending their savings to somebody else's economy. Europeans are not bad savers. In 2022, they saved 1,390 billion euros. Americans saved 840 and still ended up wealthier. The savings simply sit still. Funded pension assets are 32% of output in Europe, against 142 in America. So the risk money sits elsewhere. 5% of global venture capital is raised in the Union. Draghi adds that fragmented markets ask for less of it. So what would it take to change this? Start with the baseline. Since 2015, European productivity has grown 0.7% a year. At that rate, the Draghi report says, European output would merely stay flat until 2050. Not fall, just stop. The report's answer is money. An extra 750 to 800 billion euros every single year. That is the scale of it. The Marshall Plan was worth 1 to 2% of Europe's output. This one is more than 4% every year. Europe has invested at that level before. The last time, this is what it looked like. Commission and IMF simulations suggest a push that size would lift output around 6% within 15 years. Modeled, not promised. Some of it needs no money. One proposal is an optional 28th legal regime for companies that operate everywhere. 1 year on, an independent audit counted 383 Draghi measures. 58 were fully implemented. The Commission counts differently. Its own review counts flagship initiatives launched and money mobilized. Mobilized is not spent. Draghi warned that a managed, gradual decline would be a slow agony. Strip everything else away and one number is left. Per person, adjusted for prices, Europeans are 34% behind Americans. Now go back to that factory floor. Nothing on it is broken. Outside the gate sits a market of 440 million people. What is missing was never the scale. Stagnation is not weather. It is the sum of decisions taken and decisions avoided, which means it is still a choice. Every figure here is sourced in the description. Draghi, Eurostat, the IMF, the ECB.